On September 15, 2008, Lehman Brothers, a 158-year-old Wall Street giant, filed for bankruptcy, the largest in U.S. history, wiping out $600 billion in assets overnight. Stock markets plunged 500 points in a single day, and millions watched their life savings evaporate. But this wasn't the start of the chaos. It was the explosion. How did a booming housing market turn into the worst financial meltdown since the Great Depression? And why do the echoes of that crisis still whisper warnings in today's economy? This video uncovers the hidden mechanics, the ignored red flags, and the patterns that keep repeating, because understanding 2008 isn't just history. It's your shield for what's next. In the early 2000s, America was riding high on what seemed like an unbreakable economic wave. The dot-com bust of 2000 had faded, and low interest rates set by the Federal Reserve under Alan Greenspan fueled a massive housing boom. Home prices soared up 124% from 1997 to 2006, convincing everyone that real estate was a surefire path to wealth. Why rent when you can own? Became the mantra as banks loosened lending standards to chase profits. This is where subprime mortgages enter the story. These were loans given to borrowers with shaky credit histories, often with teaser rates that started low but ballooned later. Institutions like Countrywide Financial and Washington Mutual pushed them aggressively, bundling thousands into securities sold to investors worldwide. Wall Street wizards transformed these risky loans into complex products called collateralized debt obligations, or CDOs, essentially packages of mortgages sliced and rated, with the safest slices getting IA stamps from agencies like Moody's. Everyone believed this was foolproof because housing prices only went up, right? It's different this time, they said, echoing the complacency phase of every financial crisis. Leverage piled on as banks borrowed heavily to amplify returns, underpricing the real risks. But beneath the surface, a ticking time bomb lurked. What if home prices stopped rising? Small cracks were already showing in overheated markets like Florida and California, where speculative buying had inflated bubbles. Foreclosures ticked up slightly in 2005, but most dismissed them as isolated. After all, the economy was strong. GDP grew 3.5% in 2006. Yet, as we'll see, these were the first whispers of excess turning dangerous. The first real crack appeared in mid-2006, when used home prices peaked and began a subtle decline. Most people didn't notice at first after all. The Dow Jones was hitting record highs. But subprime borrowers, hit with rate resets, started defaulting. By February 2007, HSBC, a major lender, announced $10.5 billion in losses from bad U.S. mortgages. Warnings from economists like Nouriel Roubini went unheeded. He predicted a housing-led recession, but Wall Street laughed it off as the warning phase kicked in. By summer 2007, the problem had spread. Bear Stearns, a venerable investment bank, saw two of its hedge funds collapse under the weight of toxic CDOs, losing nearly $1.6 billion. Investors pulled back, but the Fed cut rates to calm nerves, masking the acceleration. They didn't realize how interconnected everything was as credit markets began freezing. In August 2007, BNP Paribas halted withdrawals from funds tied to U.S. subprime debt, sparking a global liquidity crunch, what experts call the credit squeeze. Then came the panic in early 2008. On March 16th, Bear Stearns teetered on bankruptcy, its stock plummeting from $170 to $2 a share. The Fed orchestrated a fire sale bailout to JP Morgan Chase for $30 billion, averting immediate disaster but exposing vulnerabilities. Warning signs multiplied. Foreclosure rates doubled to 2.2% nationwide, and AIG, the insurance behemoth, reported massive losses on credit default swaps, those insurance bets on whether loans would fail. By July 2008, IndyMac Bank failed, the largest thrift collapse in history, costing the FDIC $8.9 billion. The point of no return hit in September 2008. Lehman Brothers, laden with $60 billion in toxic assets, sought buyers but found none. Treasury Secretary Henry Paulson and Fed Chair Ben Bernanke decided no bailout this time, believing it would teach moral hazard. What happened next shocked everyone. Lehman's failure triggered a chain reaction, as the acceleration phase turned to full panic. Money market funds broke the buck, and global credit halted. What started in the subprime sector suddenly exploded into the heart of Wall Street. On September 15, 2008, Lehman Brothers declared bankruptcy, sending shockwaves worldwide. The Dow dropped 504 points that day, the worst since 9/11, and $700 billion vanished from retirement accounts in hours. Then everything cascaded. Merrill Lynch, bleeding from similar bets, sold itself to Bank of America in a desperate merger. AIG, insurer to the world, faced collapse under $441 billion in credit default swaps gone bad. The Fed stepped in with an $85 billion bailout, effectively nationalizing it. The human cost hit hard. Ordinary people like construction workers in Las Vegas saw jobs vanish as homebuilding halted. Unemployment spiked from 5% to 10% by 2009, affecting 15 million Americans. Families lost homes in waves. 2.8 million foreclosures in 2008 alone meant evictions, shattered dreams, and tent cities sprouting in suburbs. "I thought my house was my nest egg," one victim recounted in congressional hearings, but teaser loans turned toxic. The moment of maximum fear came on September 29th, when Congress initially rejected the $700 billion Troubled Asset Relief Program, or TARP. The Dow plunged 778 points, the largest single-day drop ever, erasing $1.2 trillion in market value. Credit froze solid. Even blue-chip companies like GE couldn't borrow. Then everything changed. Panic forced action, and TARP passed on October 3rd, injecting capital into banks. But the damage was done. This was the collapse phase in full force, where confidence evaporated overnight. In the immediate aftermath, authorities scrambled. By October 2008, TARP funds stabilized banks, while the Fed slashed rates to near zero and launched quantitative easing, buying trillions in assets to flood the system with liquidity. Globally, governments coordinated bailouts. The G20 pledged $1 trillion in stimulus. The Great Recession dragged on until mid-2009, with GDP contracting 4.3%, the deepest since World War II. What many don't realize are the hidden costs. Wealth inequality widened as the top 1% recovered quickly, while middle-class households lost 39% of net worth. Socially, it fueled populism, from Occupy Wall Street to political shifts. Politically, it birthed reforms like the Dodd-Frank Act in 2010, which curbed risky banking and created the Consumer Financial Protection Bureau. This collapse followed the exact same arc as past crises, like the 1929 crash or the 1998 Asian financial crisis. It started with complacency, a belief in endless housing growth. Excess followed, with leverage ratios hitting 30-1 at firms like Lehman. Warnings from falling prices were ignored. Acceleration spread via interconnected derivatives. Panic ensued in credit markets, and collapse seized the system. Understanding this crisis teaches us that financial systems are fragile ecosystems, where underpriced risk and herd mentality amplify small problems into catastrophes. Every financial crisis has this pattern: ignored signals leading to systemic failure. And today, we see echoes reminding us vigilance is key. The 2008 financial crisis taught us to watch for complacency in new paradigms, like the housing bubble then or today's sky-high stock valuations amid AI hype. Leverage excesses mirrored in current corporate debt levels, now over $10 trillion in the US alone. And warning signs? Look at persistent inflation pressures, post-2022, echoing the rate hikes that popped the housing bubble. Or the rapid growth in speculative assets like cryptocurrencies, where volatility recalls subprime's underpriced risks. Is this pattern repeating? History suggests we should pay close attention. Rising household debt-to-income ratios today hit 130%, similar to pre-2008 peaks. These signals we ignored then are appearing again now, urging smarter investing and policy awareness. At its core, 2008 revealed how interconnected risks can topple empires overnight. The question isn't if patterns will repeat, but are we prepared when they do? What do you think are the warning signs we're missing today? Drop your thoughts in the comments below. I read them all. If this sparked your interest, hit like, subscribe, and next we'll explore the dot-com bubble. Lessons from the tech crash. Thanks for watching.